Hi everyone, in this video we're going to be walking through the Sam's Singles practice set. This is kind of a case study type project where we are going to put ourselves in the shoes of a bookkeeper for a certain company, and we're going to walk through the creation of journal entries, posting those entries to the general ledger. We're going to do some analysis and post adjusting entries. We're going to prepare an adjusted trial balance, financial statements, and then prepare the closing entries. So just to walk you through quickly the structure of the Excel template for the project here, we've got some information about the company. We have a post-closing trial balance for January 31st, and we're going to be looking at February. So here we can go to our beginning balances tab and see that post-close trial balance for January 31st. Again, we're going to be looking at February transactions. So what that means is, in essence, is that these will be our opening balances or beginning balances for the month of February for these specific accounts, and then we will work off of those. We've also included the AR subledger and AP subledger that tie in here. You can see to the amounts listed in AR and AP, just so we have some detail about the composition of those balances here in the general ledger. When we see some of the transactions that we're going to have to analyze, it will be things like collections and payments related to these prior month balances. Okay, so there's that portion. And then down here, we've got a whole listing of transactions and other information to consider in our work here. So we've got the transactions numbered. We're going to basically account for 28 different transactions. We've got dates, descriptions of the transactions, and then the amounts here in this column. The first 23 transactions are just more general, ongoing day-to-day type journal entries. And then for the last 5 journal entries here, 24 to 28, we're going to be doing adjusting journal entries with this information. Here I've put some notes just to go to this analysis tab. So on this analysis tab, we'll be able to do the analysis and come up with the amounts that we're going to need for our adjusting journal entries, at least for 4 of those adjusting entries. One of the adjusting entries here is really just the addition of 2 amounts. There's not really analysis per se to do for this one, so I just included that here. And similar to some of the assignments that you've seen for our homework, etc., I've put these in these columns here with the amounts so that we can link from these cells in using Excel functionality and reduce the risk of making typo errors, so on and so forth. So, okay, so let's get started here. Let's start with transaction number 1. And as we noted here, 1 through 6, we're going to begin by preparing our journal entries. So here we'll go to our journal entries, general journal tab. I've put some information in here for you all just as a starting point. So the dates are already input for you. You can see all the way down here to our adjusting entries, and descriptions also have been included. So we just need to focus on the specific accounts that we want to use. Okay. So let's go ahead here and look at our transactions. So the first item on February 1st says that we issued check number 100 to Mail House for postage and handling on a mass marketing letter that we sent out, the company sent out that afternoon. So we're basically going to be paying this amount, $180 for advertising. So just to kind of reiterate the point, we can link our journal entries here to the amounts just to make things a little simpler. And then we can do a link here to get our totals to match debit and credit wise. And then we just need to think about, okay, if we're spending money to have a promotional campaign, we're going to call that, excuse me, advertising. And remember, it's an expense. This isn't a prepayment or something that's going to allow us to receive future benefit. This is just a marketing campaign that's happening in the current month. Once that time, this month passes, we'll have no future benefit for the company. So we're going to have an expense associated with that. And then It says in the transaction details here in the instructions that we issued the check. So remember that when we're writing a check, we're just basically adjusting our cash account for that transaction. We don't have a separate account, for checks written versus cash spent. We use this just the cash account. Okay, so let's look at the second transaction. February 2nd here, we signed a 1-year lease for office space, and we paid February's rent of $2,200. So $2,200. So this one's a little tricky. You have to make sure you read this one, because it could sort of lead you astray. If you see the fact that we signed a 1-year lease, you might assume that we're making a payment for the full year. But then the instructions go on to tell us that we are paying February's rent only, so just the rent for this month of $2,200. So we can go here. Again, somewhat similar to advertising expense. It's an expense, but now we're paying for rent. And same situation in this instance, we mentioned in the instructions that we issued a check, so the payment was made, so therefore we will credit our cash account. Let's link to that balance, and then we can just link to the cell there to make sure our debits and credits are equal. You could very well just link the credit to that same cell in that fashion, so on and so forth. But I find it easiest just, if you've already got this linked over, then you can just link off to this cell, because it's just a little cleaner to keep the links within one page. So just a preference thing, but that's how I'm going to prepare my journal entries here. Okay, let's look at the next transaction. For the third transaction, which also happened on February 2nd, we issued a check, so we're going to be crediting cash again. To this company, it's $8,900 to purchase some business equipment. So $8,900, and we are purchasing equipment. So we're just going to call this equipment. That's fine. And as I mentioned, we did not purchase this on account. We actually made payment for it. So we're going to credit cash, as I mentioned. Okay. And we're good there. Let's go on to our next transaction. Here on February 3rd, we performed a consultation and billed the customer $3,000. So we're going to go here. And remember when, let me slow down a little bit. Let's look at this transaction. The fact that we billed this customer, or we sent them an invoice, indicates that we have not received them cash yet for this service that we provided. And so therefore we're going to use our accounts receivable account instead of cash, right? In the future, we will collect that cash. But for the time being, we have provided the services, so we are owed the money. So we are going to record the service revenue here. But we have not yet made the collections of cash. So that's why we use accounts receivable. Find my spot here. Okay. And we can do the same thing, linking through. Okay, let's go on to the next transaction here. And this is on February 3rd as well. But the fifth transaction. So here we purchased 6 months worth of liability insurance. We paid for that, with the check. So we know we're gonna credit cash, and we paid for 6 months worth of insurance. This is the beginning point. No time has passed under this contract at the time that we're making this payment. And so the way that we record that is to debit a prepaid insurance account, and then we issued the check, so we know we're going to credit cash there. So prepaid insurance, $1,800. Link that over. And we're going to come back to this one when we do our adjusting entries at the end of the month here. And we will come back to analyze, and just remember that this is accounting for 6 months worth of prepaid insurance. And in our instance, let me see if it actually says it here specifically, but we will discuss down here, I believe, by the end of February, 1 month's insurance had expired. So we'll come back to that as I mentioned, but this payment of $1,800 does include the month of February. So we're going to need to first record that full prepaid insurance asset, but then cut off, if you will, one month's worth, 1/6 of this, and take it away from being an asset to an expense. But as I mentioned, we'll revisit that and do that when we come to our adjusting entries later. Okay, on February 4th, we received $10,000 and issued shares of common stock. So this is us receiving cash, or the business, I should say, receiving cash of $10,000. And we are going to credit the common stock account. So this is essentially, the title here is a little play on words, I suppose. But we have a friend, Amanda friend, whatever the name here was. We're basically saying we've sold a portion of our business. It doesn't go into detail about the total ownership percentage, etc. That's not really required in preparing this whole project. But the idea of this transaction is that some portion of our business we have just sold essentially to this individual. And when we sell the business, selling a portion of itself has cash coming in. So common stock there. Okay, let's look at the next transaction here. On the 5th, it says that we received $3,500 total for services performed the previous month. So we have $500 from Dudley, $2,000 Gooseman, $1,000 from Telmuch. So we should see those balances here. Dudley, Gooseman, Telmuch. I think it is these three. And really, if we were to look at this in detail, it would just be a portion of the total collected from Dudley, it looks like, because the total outstanding amount is $3,500. We're only receiving $500. We did get $2,000 from Gooseman, so that full amount balance has been collected, and then $1,000 from Tammy Telmuch. So that is going to be fully collected as well. So really, Jim Dudley will still owe us $3,000, it appears, because we only collected $500. For our purposes, we're not maintaining an ongoing AR subledger, etc. So we're not going to worry too much about that. But it is good to just kind of know where that amount is coming from. In the real world, you would want to have a maintenance of a schedule like that because, for example, if you collected just a portion from this customer, you are going to want to continue collections, efforts and sending new invoices out to them or account statements, etc., to try and collect the rest of that balance. But regardless, here we've got $3,500 in total collected. And so when we say we are collecting that means we are getting the cash. So we'll link that in there. Debits equal our credits. And we're going to credit accounts receivable to indicate the reduction of that AR asset balance and also indicate the fact that we've made those collections and they are no longer to be received in the future. Okay, let's look on 2/7. So on February 7th, we had a speed dating night. We had $60 for each customer, 50 people attended, cash was collected from all but 2 who agreed to mail in a check later. So we have here, I've got a calculation in here, 50 people times $60 per person means that we earned $3,000 in revenue in total on the 7th. And it kind of differentiates here. So this is I like this transaction. Let's start with the service revenue piece. So we're going to record service revenue of $3,000, as I mentioned. And then we are going to record a portion of this in cash, and then also going to record a portion of this as an accounts receivable. And as it mentions here, if we read the instructions, all but 2 of the participants paid us. So if we want to record that, we could say all but 2 would be 48, because it was 50 total, times 60 equals 2880, 48 people paying $60 per person. and then 2 individuals who are waiting still to pay us. So we'll take 2. So 48 of them did pay us, but 2 of them did not yet pay us. So we billed them essentially. And that means that we're going to have $120 that will come in later. And then you can see summing those 2 up gets us the $3,000, which agrees to our total service revenue. Okay, on February 8th here, let's take a look at that transaction. We received an invoice for $600 for an advertisement that ran in last week's newspaper. So again, an advertising expense, no future benefit to the company. It's already been published, and so that's why it's an expense as opposed to a prepayment. And I almost put cash in there. I believe it said that we received just the invoice. So we received the invoice, but we have not yet made the payment. So that's going to be accounts payable. So that liability that we will need to pay in the future. Okay, making progress here. All right, here we go. Let's look at the next transaction that happened on 2/8, transaction number 10. So here we performed a dating consultation for the customer and received $6,000. So received, indicating paid in cash. Just link this over. And we're going to say service revenue. And there we go. Pretty straightforward. Okay, transaction number 11, which happened on February 9th. We paid the outstanding invoices to Sun Company, Moon Company, Stars Company, $2,000. These were accrued last month. So again, if we look to our beginning balances spreadsheet here, our AP subledger shows a total of $2,000. We're making a $2,000 payment. So we're paying off all of our bills from the prior month essentially in full. So let's go ahead and come over to here. So again, we're going to use the accounts payable account, but opposite to what we did up here where we received an invoice and incurred a payable and an expense. Now we're making a payment to pay off accounts payable. So whereas a credit is an increase to a liability, a debit is going to be a decrease. So that's why we're going to debit that $2,000 there. And then as we're making that payment, essentially what we're saying is our cash is being reduced. And so we're going to credit cash there to reflect the payment for those. Okay, transaction number 12, which happened on February 10th. We received $60 and $60 from 2 different customers. So this is the amount, the residual payment then for that receivable here that we were waiting for. And so we are going to actually just record the cash. And we can even just link this one back up here because now it's become cash. And then accounts receivable. So here we can see the accounts receivable asset was increased to reflect the fact that we were going to receive the money. Here we are now receiving the money and receiving the cash, and we are reducing our accounts receivable balance to reflect the fact that we have now made that collection. Okay, on February 11th, let's take a look at that transaction. We purchased $800 of office supplies on account, and we will use office supplies asset account. And then importantly, it said that we purchased this on account. So that's, again, we haven't made the payment yet. So that's going to be an increase to a liability, accounts payable. And an increase. So we've got an increase to an asset, office supplies, and an increase to a liability, which we will need to pay in the future. Okay, we're on to the 14th here. Transaction 14 on the 14th. We received an invoice from a law office for legal advice that they provided. So we've got a bill in the mail that we need to pay in the future. So hopefully that rings the bell for you that is accounts payable. And then we're going to say legal expense because they provided us the consultation, the services, there's no future benefit. We're not purchasing anything other than a service from a service provider that has already been provided. So that is an expense. All right, on February 15th now, we hosted another dating night situation, and we had 40 participants who paid $60 each. Everyone paid. It says there's no receivables associated with this this event, and so 40 times $60 per person comes out to $2,400. We received all the monies, like I said, and we earned the service revenue. So which one was that? That was here. Actually, I want to stick with my method of linking the debit and then just linking the credit to that cell. Okay. So that was the 15th. Let's just go through, make sure we've got everything good there. All right, looking good. And let's move on to the 16th. Transaction 16 as well. Okay, so here we are, we're making a payment to a catering company. They had provided refreshments for us at our dating events. And so we're going to go ahead and use event expense. And, you know, if you were the accountant of this business and decided, you know what, I'm going to use refreshments expense, maybe you have different accounts for these types of things, but for our purposes here, we're just going to use event expense because that was one of the expenses that was related to putting on this event. And it did say that we cut the check for this, so we're going to credit cash to reduce that. 216. And payment made. Okay, let's go on to the 17th now. On the 17th, we received a $12,000 advance, so we are receiving a prepayment from a customer to be provided both in February and March, but no services, you know, at this point on the 17th having yet been provided. So we received the payment, so we're going to debit cash. Link over there. And then remember that we have this account called unearned revenue that we use when we receive prepayments. And don't get confused, I suppose, which is a common thing because the name, you know, the word revenue is in this account's name. It's not yet revenue. It is currently a liability until we earn that revenue. And so again, we'll revisit this later here when we look at our adjusting entries. Okay, now we're on to the 18th. We observed, we did services. Okay, so we're just being paid here for services of $6,000. So we received the payment. Let's link that over, 6,000. And we use our service revenue account. So this is actually earned revenue, and we'll compare that to a prepayment where we have a liability of unearned revenue. So just a comparison there. Okay, let's look at the 23rd. So on the 23rd, we did a consultation for someone, and we billed this customer. So again, we're going to use our accounts receivable account. Link there. And service revenue. Okay, that's looking good. And then on the 24th, we're making some payments here for Office Depot and the legal invoice that we received. So 2 $800 payments, and those payments are going to be made to reduce outstanding payables that we had. Cash will be reduced, you know, as the payment is made. And let's find it here. Which one are we on? There we go. And you can see kind of these, I think that was related to these two two purchases, one of office supplies, one from the legal firm, and then this is the actual payment of those amounts later. Okay, so we're on to the 25th. Here we have an issuance of dividends totaling $1,000. And so we will debit dividends, which is an increase to dividends of $1,000. And then we will credit cash. And keep in mind, I mean, this is a sort of a way to think about dividends. It has a similar debit, you debit an expense and you also debit dividends, but they're two very different things. Remember that expenses are payments that you incur for made in the pursuit of revenue, essentially, in business operations, whereas a dividend is just a withdrawal of the cash from the business to be paid out to the business owners. So it's a reduction of the business's cash balances, but just as for a very different reason than an expense. So keep those things in mind. Okay, on the 27th, let's look at our instructions here. We received an invoice for $150. So let's go back here, and we're going to use utilities expense as our expense account. And we didn't make payment yet, so we're doing accounts payable. Make sure I got that in the right spot. Yep. Okay. Great. And now we're on to February 28th. And so this one's real similar. We got a PG&E bill. This was a cell phone bill, now a PG&E bill. And we're going to group those together into use the same account, essentially. So utilities, expense, and accounts payable. Again, if you were the accountant in the real world and you wanted to break these into separate expense accounts and have one that was a telephone expense and one that's electricity, utility, something along those lines, fully within your ability to do so, but we're going to just group those together into utilities expense in my presentation here of the overall breakdown. Okay, so let's go to the 28th. So now we have gotten to the point, I believe. Yes, so we're on to the adjusting entries now. And we're going to come over here to our analysis tab and use this tab and the kind of template laid out here to do some of the calculations that we're going to need for those adjusting entries. So let's go ahead and do that now. Okay, so when we're doing our analysis related to the adjusting entries, we're going to need some specific information. And essentially that information is included here, but it's also provided in our analysis templates here, if you will. So let's start and look and see what we need to analyze. So surveillance equipment purchased on 2/2. So if we go back to 2/2, that was this one. So $8,900. So we can go ahead and link in the cost of that equipment too while we have that amount there. It has a 40-year life and a $500 expected salvage value, and the company uses the straight line method for depreciation. So, okay, so we're going to take in the cost of the equipment. We're going to subtract out the salvage value, and then we're going to sum those together to basically make a subtraction. But $8,900 minus $500 gives us a depreciable base of $8,400. The useful life in months, because we're just going to record 1 month's worth of depreciation here. And let's see how it's 4-year life times 12 months per year means that it's going to have an expected useful life of 48 months. So finally, to get our monthly depreciation expense, we're going to take our depreciable base, divide by the life in months, and that leaves us with $175 of depreciation expense per month. So now we can come back here and record our first adjusting entry. for the depreciation expense that we have just analyzed there, calculated. And remember, we're going to use this account called accumulated depreciation. We're going to credit that in our depreciation entry. Remember, the accumulated depreciation is a contra asset account, which means that it reduces the value of an asset account, which makes sense because that's what we're trying to do, is show the reduced value of that equipment over time as its estimated useful life is worked through essentially, or used up. Okay, let's go back to our analysis tab here and look at our office supplies adjusting entry and analysis. So at the end of the month here, at the end of February, the company has supplies on hand of $200. So in essence, someone counted the office supplies and realized, okay, we have $200 left. Now let's fill out our analysis template, so we need to account for the beginning balance. So we had $50 in office supplies to start at the beginning of the month. And then let's go through our journal entries. I believe we bought some office supplies throughout the month here. Let's find that. Here it is on the 11th. We bought $800 more. And that was the only entry to office supplies or purchase of office supplies other than having the beginning balance. And then we're going to subtract out the beginning balance left over, because what we want to see is how much did we use up, right? So if we take, essentially what we're saying is we're going to take beginning plus the amount purchased minus what's left over. So the difference between 850 that we had to use in total minus the 200 left over means that $650 of the supplies were used up, and that's the balance that we're going to record as an expense during February. So we will do supplies expense for our debit. We'll link to that 650, and then we're going to credit our office supplies asset account to reduce that balance down to, after this recording, which we'll see when we work on the ledger, the ending balance in office supplies then will come out to be $200 to match what we counted, essentially. Okay, let's look at the next adjusting entry here. Actually, let me go back to this. Okay, one of our adjusting entries, we didn't really need to do any analysis. So actually, we're going to do this one next. And we're going to say salaries expense. And we're just going to link that in. We don't really, like I mentioned, I didn't include it on the analysis section because there's not really much to analyze here. These are the amounts that are paid for salaries, and that's about it. There's no breakdown in number of days or anything like that. So, and then do keep in mind, this is a gross oversimplification of how salaries and payroll expenses are recorded, but typically you would have all kinds of payroll taxes and things of that nature associated with payroll type expenses, which we do cover separately in this class. But for simplicity's sake, we're just going to debit salaries expense and leave it at that. And then we're going to record salaries payable as the credit, the liability. We're going to make this payment in March to these two individuals. Okay, and let's see, on the 28th here. So we're past that one. Okay, so now we're on to a portion of earning some of the unearned revenue here. So let's go back to our analysis tab. And so the advance amount, or the prepayment amount, if you will, this was on 2/17. So let's go to 2/17 entry. So unearned revenue. So we got paid $12,000. And then it notes that we have performed 25%, so 0.25, 25% of the services in total we have performed. So we now, while this was unearned revenue to begin with, we have now earned 25% of that, or $3,000, basically. So now we're going to come back to our general journal here, And remember, unearned revenue is a liability. So to reduce a liability, we are going to debit and 3,000. So we're reducing the amount of the unearned revenue by 3,000. And we're going to kind of, I almost think of it as like just changing or transitioning the unearned revenue into revenue as it's earned. So now we have earned 3,000. That's recorded on our income statement. And we still have, if we were to look in the ledger, which we could do in a moment, 75% would still be unearned, which would be $9,000 left over to still be. So basically additional services that need to be provided to this individual going forward next month or whenever it happens. Okay, we're coming to the end here. Our final adjusting entry. As I mentioned before, when we were doing the initial journal entry, we made a payment for insurance, prepaid insurance. So let's go back and find that journal entry. Prepaid insurance. So we prepaid $1,800. We paid for 6 months. That covers 6 months. And we used up 1 month here in February. And really, we'll divide that by the 6. So what we're saying is each month's insurance is $300. We paid for 6 months worth, up front. And so that means that every month we have $300 of insurance expense that has to be recognized as the time passes. And we will do that now. So insurance expense. Let's link to our analysis. And we're going to reduce our prepaid, spell it right, prepaid insurance asset. So now that we've used 1 month's worth up, you can see here, you start with 1,800 minus one of the months leaves us with, we'll see 1,500 after we record that entry. And 1,500 makes sense because that will be 5 months at $300 per month. 300 times 5, 1,500. So hopefully the logic there is clear. Okay, so I think we've got our general journal filled out and we're looking good now. Our analysis is complete. Let's look back at our instructions. So we've now entered all of our transactions into the general ledger or journal. I guess I kind of skipped here to number 2 of journalizing and posting adjusting entries, but that's fine. We can now jump onto our general ledger and wrap up steps 1 through 3. And one thing to note, I've done a few things for you all in the ledger to help kind of speed up the process of completion. So I've taken some of the busy work out of it and, also given you hints about how to proceed when we're moving through preparation of the ledger. In the real world, these kind of things often do auto-populate if you're using an accounting software like QuickBooks, etc. So it's not really unheard of that you would actually just go into a ledger. If you hadn't recorded these entries yet, you might not see them. But do keep in mind one thing that we kind of lack, I guess, in this course is not using a specific accounting software. Excel is amazing and it's a great tool. But if you get out in the real world and you're using something like a QuickBooks, it will auto-populate information like this based on posting journal entries. As you put this journal entry into the system, you could automatically go to the ledger and that information would show up. So not a completely unrealistic scenario to have some information already kind of there. But anyway, so that's there for us. And then I did go ahead and input all of the opening balances as well, or beginning balances. This all matches up here. So you don't have to worry about putting those in. Those are there for you. What we need to do primarily is we need to input all of the transactions that affect all of these different accounts, right? So we've got all revenues, expenses here. There's dividends, common stocks, some equity stuff, liabilities. And we'll start with our assets, beginning with cash. Okay. So we need to go here essentially and look for all the transactions that have cash impacts. And we're going to bring in those. We're going to post those, the correct term, to the general ledger. So for the first one, we had a payment for advertising. The second, on 2/2, we made an entry for a payment for rent. second transaction on 2/2 that we purchased the equipment. So there's cash again. You can see we're going to skip this entry, but 2/3 we're going to come down here. There's another cash payment right here for the prepayment of the insurance. Excuse me. Then we had a cash receipt into the business here. We're going to have another cash receipt. We received some collectibles, but this was on the 4th, or some receivables, I should say. So receipt payments on the 5th, $3,500. Let's see. Okay, so here we had revenue from our, most of it that was paid on the 7th. So we'll go to the 7th here, $2,880. So that was that. We recorded the $3,500. Okay, so now let's go to February 8th. Here we are. Received a payment for some services provided. Here is a payment that happened on the 9th. So we're going to reduce cash now. Okay, on the 10th, we had a receipt of amounts owed. So I think that's the 120 there. Yep. Looks like we're not going to have any cash impact from these two entries, but on the 15th, we are going to have a payment that we earned or received. Okay, then we were making a payment here on the 16th. So cash decreasing with the debit, or sorry, with the credit. Prepayment received. Again, this is kind of the interesting one here, where we have this money coming in, but do keep in mind this is not our money at this point. This is unearned revenue that we are basically just holding on to for the client until the point at which we actually provide them the services. So just kind of interest, to keep that in mind. Okay, the next one, revenue earned on the 18th. We had a cash increase, and here we made some payments on the 24th. Some cash decrease there, and finally we made a dividend payment out of the business, so that will be a reduction as well. Okay. Okay, so now we've got all of these debit and credit transactions within the general ledger here for the cash account specifically. We had a beginning balance in cash of $25,000. We want to account, for all of these situations here. And so as we kind of move through this, we can create formulas that'll help us do just that. So remember, we have a debit balance for cash. Credits to cash are a reduction. Debits being credited will be an opposite impact. And so we can basically say with our formula, take the cell above 25,000 minus that credit amount there. And then we can drag this down so that you'll continuously see the amount above it being reduced by the next credit, essentially. So each one of these is just the same as the formula above, just continuously reducing by the credits. But now here, when we get down to the debits, we're going to want to modify our equation a little bit, not to be a reduction, but instead to be an addition, right? So we have 11,920. We want to debit that debit, which is, increasing it. And then again, we can just drag that same one down, similar type of thing, where the balance preceding is then increased by the debit minus the credit. So you just kind of have to work it back and forth. Is probably the easiest way to do this process. If you wanted to get fancy with Excel, you could figure out some methods to create maybe some more advanced formulas that could accomplish that same task of sometimes using a minus, sometimes using a plus. But for our purposes, with relatively basic Excel, we've accomplished that fact of that whole process of maintaining the running total. And so what it shows us is that our ending balance in cash is $48,590. All right, let's move on to the next account, accounts receivable. So here we started with an $88,500 balance, and we're going to be recording all of our activity. So on the 3rd, it looks like we had some accounts receivable activity. So, okay, here we are. Yep, debit to accounts receivable. On the 5th, let's take a look at that one. We're just looking for accounts receivable, and yep, oh, here it is. But let's be careful because it was not an increase, not a debit, but rather a credit. So let's credit that. On the 7th, it was revenue earned, so I believe that we are looking at a debit there. Let's make sure. Yep, that's the small portion of the receivable there. And then we got paid some amounts on the 10th, so let's go and account for that. So that's a reduction. You can see an increase, and then the payment being decrease. That's the life cycle of accounts receivable. And the final transaction on the 23rd, 210, that was the last one there. We can kind of, as we review through, just make sure we didn't miss anything. But yep, we're on to the 23rd. We have a debit, and that's great. Okay, so now let's do the same thing we did with cash. So we're going to increase the debits, take your previous balance minus the credits, previous balance plus the debit, previous balance minus the credit. This one really goes back and forth, so can't really drag down this formula to save us some time, but not as many transactions either, so not too bad. Okay, let's go on to office supplies. We previously talked in our analysis tab about the fact that there was an opening balance of $50 in office supplies, so that's reflected there as well. And then on the 11th, we purchased some office supplies, so that was an $800 increase. And then on February, as a part of recording our adjusting entries, we noted that we used up a certain amount of office supplies. Let's find that here. Where'd that go? Here we go. $650. So not too many transactions to account for there, but let's add the previous plus the debit and then take the previous minus the credit. Here we end with $200. And remember when I mentioned this whole section, where was it at? Yeah, of us, we have supplies on hand of $200. So when you now look at the ledger, you see $200 reflected there as well. And when we say $200 on hand, here that's reflecting a physical count that we actually did. And so now after making this adjusting entry, our general ledger balance now agrees to the physical count that we performed. And that's what you would want to happen. Okay, let's go on to prepaid insurance. We had no beginning balance in prepaid insurance, so we're just going to get right into the journal entries during February. So the first transaction here on the 3rd was that we purchased we made the prepayment for those 6 months on the 3rd. So here we are, so $1,800 increase. And we could just carry that over to the running total. No beginning balance to account for here specifically. But then we recognized a portion of the prepaid insurance, for the 1 month of February. So we're going to credit prepaid insurance there. So now we can say, the balance before that adjustment is a debit, it's an asset, minus a credit, and we end up with $1,500 in prepaid insurance left over after February, which again makes sense because we determined that it was $300 per month of insurance is how much each month's insurance expense is, and we have 5 months left over after recognizing the first month. So 300 times 5 makes sense, 1,500 left over, and we'll have insurance now for the next 5 months as well. All right, so equipment, we just made that one purchase on the 2nd. So let's go back there. Here we are, $8,900. Okay, that's all that we need to record in the equipment account. For the accumulated depreciation account, remember this is a contract asset, and that's related to our adjusting entry here. So we'll scroll down to the bottom. Here we go, 175. Oh, one thing we should do, let's carry our totals over to the running total. And we want to have the credit there. Perfect. Okay, that's all of our assets. Now we're on to our liabilities. And remember, our liabilities have a normal balance or a balance they should typically have is a credit balance. They increase with credits, etc. If you had a debit balance, that would mean they were negative, which usually doesn't really make sense. And so we would always expect to see a credit balance for liabilities, a debit balance for assets, as we saw above. But yeah, a little different on the accounts payable on the liability side. Okay, so let's look at AP impacts here from our accounting. Looks like on the 3rd, I believe. Oh, was I? No, maybe I was wrong there. Let's see. Let's go through and find. Okay, I'm on the 8th here. We had our first increase in accounts payable. And then we had prior month AP payment on the 9th. So that's going to be a reduction. Let's go ahead and find that. Here we go. Purchase of office supplies. So that would be an increase. Let's go to the 11th. Yep, there we are. We're going to have another one right below it, I can tell. Legal services provided on the 14th. AP credit there. It's in the credits. Now we've got some AP payments happening. So those will be reductions in AP. And that looks like we're on the 24th. So right there, $1,600 debit. And then we have the receipt of 2 utilities invoices at the end of the month, 27th and 28th. Here we go. So the 27th. And that was there. And then 28th right after it. So 150 and 230. So that's there. Okay, and then we're going to, essentially do the same thing we did for assets here. We're going to take the previous balance, but this time, since we're in credits, we're going to add the credits and we're going to take the previous balance minus the debits. So just a little different of a formula than for assets because of the debit credit difference. But overall the same process here. Take the prior, add the credits, subtract the debits, and check myself. We end up with $980. Yep. Okay. So $980 ending balance in accounts payable. And let's move to salaries payable. This one's pretty easy because we only had that one transaction on the 28th. So let's find that. Salaries payable. Let's remember to carry over the transaction total to our running total, even though they're the same amount, for consistency's sake there. Okay, we had 2 unearned revenue transactions. The first one was on the 17th, so let's go back there. So there's our credit for the initial prepayment from our customer. And then later, we had, through our analysis, determined that we had a reduction in unearned revenue of $3,000, so a debit. Subtract that out, and we have an ending balance of $9,000 in unearned revenue, still to be earned in the future. Okay, common stock. Common stock had an opening balance here, and then we did that issuance of additional common stock through the 10,000 on the 4th. There we are, a credit. So let's add those together. 35,100 ending balance. Okay, we have an opening balance for retained earnings. Remember that retained earnings, we're going to analyze this in our statement of retained earnings, part of the financial statements, and then it will be adjusted later through closing entries that we will complete as kind of the final step in this process. But we're not going to reflect the closing entries in the general ledger necessarily, but we will do the closing entries, which will end up adjusting retained earnings as we move into the next period. Okay, so service revenue, we've got a few transactions here. Now, maybe I'll make this point too. Just one thing to note, remember that for all revenues, expenses, dividends type accounts, those are all what we call temporary accounts. They only pertain to the accounting period that we're analyzing, February in this instance. And so we're not going to carry those forward in the service revenue account, in the expenses accounts, so that we will close those as part of that closing process into retained earnings. So that's why we expect to never see an opening balance in any of these temporary accounts. So just something to keep in mind there. Okay, so let's see, on the 3rd, service revenue, here we go, 3,000. There's our credit. Yeah, again, no opening balance, but we will count for that in the running total regardless. It's not often that you see, other than the closing entries, a reduction of revenue, as opposed to like cash or AP or other accounts, receivables and payables. You see those go up and down a decent amount, as the balances increase and decrease. But in general, for all your revenues and expenses, they're not it's not quite the same thing where you would have increases and decreases. It does happen sometimes if you're making a correction, or the closing entries do decrease it down to zero, things of that nature. But in general, we would always expect in the revenue account typically to just see increases. It's just recording revenue, not first it goes up, then it goes down. So just something to keep in mind there as well. So we expect to see these all in credits. So let's go to the 7th. Here's our service revenue there. That's great. On the 8th, here we go, 6,000. On the 15th, making pretty good money here with our dating business, I guess. On the 18th, 6,000. On the 23rd, 4,000, 6,000, 4,000. And then finally, this one will be related to our unearned revenue that we have now recognized as revenue at the end of the month. And this makes it a lot easier, that the comment I was just saying about the fact that it doesn't have debits and credits we have to account for, just credits, just increases essentially. And so it makes it so we can very easily just drag our formula down in this instance, and we don't have to worry about changing the formula to reflect the difference in, with debits and then credits and then back to debits, etc. So we end up with $27,400 in revenue for this month, and pretty good money, like I said. Okay, let's look at expenses. So remember, revenues are increases on the credit side. Expenses are increase on the debit side now. So we're going to go to, this is advertising expense first. So first we had 180, and then on the 8th we had another expense for advertising of 600. So we'll just add those together in the running total to get 780. Okay, rent expense, we just had one instance there, 2,200. Carry that over. Legal expense, here we go. Event expense on the 16th. There we go. At least in this utilities, we've got two different transactions to account for. There's the first one on the 27th, and then the second one here on the 28th. Carry those over. Whoop. Take your previous plus the increase there. As far as depreciation goes, just one entry, 175. Maybe I'll just take a quick moment here to, just to step back from what we're doing, and remember that when you see these journal entries, like for depreciation expense, here's our, where we just recorded the debit, posted the debit, and then remember we posted the credit side previously when we went into the accumulated depreciation here. So you can see that's 175, 175. So we should still be balancing as we go through. We're just kind of splitting up the effects of the transactions into their respective individual accounts. Supplies expense on the 28th, then that was our adjusting entry, 650. Salaries expense on the 28th, 6,500. Insurance expense was 300. And finally, our dividend payment, again, not an expense per se. What was the date on that? Sorry, let me go back. 225. Okay. But it has a similar debit credit kind of nature. Ooh, let's run these over. Forgot to do that. So $1,000 there. Okay. Just going to take a quick look through, make sure we got everything in, and great. So that's our ledger all filled out, general ledger. And now let's come over to the trial balance. And we're going to go ahead and put all our ending balances in. And this is where we're kind of most able to easily see if we've made a mistake filling out our ledger, because if something doesn't balance, then that is the result of us making a typo or messing a formula up or something like that. So let's go ahead and put this all in. Be careful, accumulated depreciation. Again, it's a contra asset, but it's going to be on the credit side. It reduces assets. Accounts payable, and we're keeping the totals that we're pulling over. Hopefully this makes sense, but we're pulling over the running totals, right? We don't want individual transactions here on the trial balance. We want ending balances, which is what the general ledger running total column calculates. Okay, service revenue. Yep, there's our 27,400. Advertising expense of 780. Rent expense 2,200. Legal expense of 800. 1630. A little bit of a tedious process, but we're getting close. Salaries expense, insurance expense, and dividends. Finally, okay, now that we have all our debits and credit ending totals for all the accounts, let's go ahead and, so I just summed up everything. So 85,605. Hey, look at that. We have the same amounts, debits and credits. We're looking good. That's what we want to see. If we don't balance here, that's kind of your first indication that something got a little bit off. And it doesn't mean, it's a very common quiz exam question you'll see is like, if this number balances, does that mean that we could, that everything's perfect? We didn't make a mistake? And the answer is no. But if these don't balance, you definitely made a mistake in your accounting somewhere. But even though these do balance, there is always the chance because, for example, one easy maybe example of where that we could still balance but be wrong is if you recorded a transaction twice, for example. So just because it still balances because the debits and the credits are the same doesn't mean that you didn't record something twice or you didn't fail to record something or so on and so forth. So watch out for that one. That's an often common exam question kind of a deal. Okay, so trial balance is good. Now we're going to come into the next tab, prepare our financial statements. So let's kind of start by just bringing over the accounts that we want to include. So remember, we're going to start with revenues, revenue minus expenses on our income statement. And we want to prepare the income statement first, because that's how we calculate our net income that we have to then take to the statement of retained earnings. So we can just link this over, just like with total numbers, and then we can just drag that down. It's a formula. It's just pulling in text, but it is a handy way to prepare some of this. Link it together, make it faster, so you don't have to hand type everything in. Okay, there's all of our expenses down to insurance expense. And then let's do the auto sum to summarize. So total expenses was 13,415. And then here we can say net income equals revenue minus total operating expenses. So we made $13,985 of net income during the month. Just out of curiosity, if we carried that out every month, that would mean that we would have earned as a business $167,820 for a year if we multiplied that by 12. So just kind of fun. This is a totally made up exercise, but perfect. Okay, so now let's prepare our retained earnings statement. So the first thing we need is our retained earnings beginning balance of $64.50. Then we're going to add in net income. We're going to subtract dividends. And what does that give us? And then we're going to add that all together. This plus this minus this. It means that our retained earnings ending balance is $19,435. So let's link that together. This is the second statement we need to prepare because this amount then goes to here. So from here to here, then from here to the balance sheet. Okay, we're getting close now. Let's link in all of our assets. So I'll populate that, and we got a few extras we don't need. So we just need to go up to accumulated depreciation. And then it started getting into the liabilities. One little thing here, be careful, you might drag this. You might just go, oh yeah, keep dragging down. But remember that the accumulated depreciation is a contra account. And so since it's a credit here, we're going to actually show this as a negative on the balance sheet. We don't show credits, debits, and credits on the financial statements, right? But we do want to reflect that the accumulated depreciation is a reduction of the equipment balance. Let's summarize these all together. It gives us $71,015 in total assets. Now let's add our liabilities together, starting with accounts payable. So down to unearned revenue. Yep, and that's our last liability account. What we got here? 980. Okay, perfect. Let's drag these. That's good. You can auto sum those again. 16,480. Okay, now let's prepare the shareholder equity section. So common stock, 35,100. Add that to retained earnings, means that our total equity is 54,535. And then we're going to add our liabilities plus our equity. And look at that. 71,015 total assets equals 71,015 liabilities plus equity. So our accounting equation is balanced, our balance sheet balances, and we are looking good. Okay, we're on to the very last step of the project, and that will be preparing our closing entries. And so for our closing entries, if you recall, as I was just talking about, we want to close out our temporary accounts. So our revenue, expenses, and dividends, and we're going to use the income summary as kind of this intermediary account to do that closing, right? So let's start with revenue. And remember, the process for closing that I think is probably a good way to think about it here. Let's get down to our revenue account. So if revenue, or trial balance maybe is a better spot to look. So if these temporary accounts here for revenue, for example, it's a credit. So to reduce that revenue to zero, as we're going to do with our closing, we're going to want to debit that. And then for all of our expenses, which typically normally have a debit increase, we want to reduce those, so we're going to credit those. So we just kind of do the opposite, if you want to think of it that way. I'm going to link these together to make this a little easier. So we have service revenue. Again, we're going to debit what was previously a credit. And we're going to use income summary account. Link those together to do that closing. Okay, so now we've got revenue closed. We're going to have income summary as our debit for expenses, because all of our expenses are going to be credited to decrease. So let's start there and go down to insurance expense. Yep, there we go. And then we can just link those balances as well off the trial balance, starting with advertising. And then we can go into the income summary cell, and just to make this balance, we can hit auto sum. It starts trying to sum something above it, but ignore that. But just go here and drag down to change the cells that it's adding together. You get 13,415. That should balance to your total operating expenses there, and it's the same thing. And we get that number. That's great. And then income summary. So you can see we credited income summary for 27,400. We debited it for 13,415. And so to get that income summary to close now, we're going to need a debit to get us up to the 27,400 to make it balance. And we can really think of that either as taking the difference between these two, and what that should come out to, or what it should agree to, is net income, right? Because really all we're saying is this is the difference between revenues and expenses, which is the same thing as net income. And we are closing this out to retained earnings, which is the same thing you see on the statement of retained earnings. So if we started with 6450, now we're adding 13985, and when we credit this 13985, really what we're doing is the same process of taking that 6450 starting balance, adding the additional 13985, So that brings us up. And then finally, we have to close our dividends account. So for that final entry, we do retained earnings of a debit, which is going to decrease the amount there by 1,000. And we can just link that in with the dividends. So dividends closes to 0. The retained earnings is increased by 13,985. All the expense accounts go to 0. And the revenue accounts go to 0 as well. And again, the reason we close those, as a reminder from that closing entries chapter, we're basically closing all of this activity or moving it, if you will, into retained earnings and zeroing out all these temporary accounts so that we can have them 0, so that when we move into the next month or the next accounting period, they just start aggregating and increasing again. And all the amounts that will be reflected then in those expense, revenue, dividends accounts only pertains, to that specific time period that we're talking about. All right, well, that basically brings us to the end of the project here. Hopefully you all found this video helpful, and I am happy to help. If you have any additional questions, reach out as